We're recording this interview just prior to the publication of the US non-farm payroll report, which again, as always, is an eagerly weighted piece of data, but particularly so this week. The US, particularly in the beginning of 2012, has been perceived to be rebounding quite strongly. Indeed, it's been some contributor to equity markets starting the year in positive fashion. But it's interesting to note that this week we've had a run of US macro data, including things like consumer confidence and PMI data, which are forward-looking indicators, and they've been missing expectations. The first time that we're starting to see that now for a few months. So non-farm payrolls have the chance of having an impact on markets. So the US to be watched, but it's Europe that, in a sense, has continued that theme of seeing the credit crisis begin to ebb a little bit lower and allowing people to put risk appetite back on. I think the charts of the Spanish and Italian yields are indicative of what is taking place here. These are the sort of crisis levels that we saw in November of 2011, and since the implementation of that LTRO program by the ECB, facilitating banks to be able to put up a much wider range of assets in return for cheap money, has allowed this to sort of move back into the sovereign debt markets, and those yields, while still too high to be sustainable longer term, are at least moving in the right direction. That, of course, is Spain. Here we have Italy, again bumping up against 7% there in November, December, back down to 5.5% at the moment. And I think that so long as we see a continuation of that, it is allowing investors to focus back on some of the positives that are around at the moment. What we will continue to have to think about over the course of this year, however, is that there's a lot of short-dated paper, and the key here is growth. We had the European summit that took place earlier this week. The whole intention of that summit was to focus on growth initiatives for Europe. Unfortunately, I think the conversation really was dominated again by Greece, where we have been looking to see a resolution of the Greece problem. We were promised some sort of deal earlier this week, which I think they would have liked to announce at the summit. But as we sit here towards the end of the week, that still doesn't seem to be any closer. And of course, we have that big deadline that's creeping up on us in the latter part of March for the debt repayment in Greece. So the time is of the pressure there at the moment. But as I say, the trick that is being played here at the moment is to try and buy time to allow economies, hopefully with this financial confidence building back in markets, to resurrect the growth profile over the next couple of years. Of course, if we don't see growth, then clearly the financial crisis will continue to stay with us. Let's take a look at how this is playing out in some of the currency markets. The euro-dollar continuing to see some sort of momentum at the sort of 131 level. I think currencies, the sterling increase here to up to 158. I did hear rumour that there was some investment banks talking about a potential rise in UK interest rates later this year if the financial crisis in Europe didn't prove to be as bad as feared. And whilst that's certainly not our view, was it sufficient to give sterling a bit of a pop there last week. Other asset classes that are moving in line with this sort of optimism around includes gold. Now, gold is traditionally the safe haven and traditionally the non-correlated asset towards positivity in equity markets, but it's a demonstration of, I suspect, leverage that is now allowable in trading assets like gold, which means that as markets start to move higher, it gives more leverage capability for people to come back in and buy gold. So we are seeing quite a strong run there. I've been looking around for charts that are generally non-correlated to this positivity. Did find this Baltic Dry Shipping Index, which has dropped 65% during the course of January alone, and actually takes it now well below the levels seen at the height of the recession back in 2008. There are technical factors. A lot of shipping capacity came online that was ordered back in the good times of 2005-06, but it's something just to be aware of that is causing a few commentators to take note. Now, looking at some of the stocks, there is a rotation taking place within the stock market out of defensive stocks like companies like Unilever and into some of the faster moving sectors at the moment. We did highlight Unilever recently when we were speaking about Tesco's and how the pressure is coming to bear at the front end on consumer spending, and some of the suppliers possibly taking a little bit of hit either on growth or latterly on margins. And we saw the first signs of that with Unilever in their updates this week, and that has caused the shares to come off. And also another stock that I think is worthy of mention is Amazon. The US reporting season absolutely in full swing, and it's fair to say that whilst overall I think the tone has remained quite positive in US corporate earnings, there have been more misses than previously, and we can see here with examples such as Google and Amazon, small misses can result in fairly painful corrections in stock prices. So again, as I say, we're seeing a little bit more in that respect impacting on prices going forward. So be aware of the rotation, and also merger and acquisition activity. We are seeing more deals taking place. The long-awaited merger between Xstrata and Glencore was potentially leaked to the press this week, or they had to respond to some sort of speculation in the press. It has resulted in quite a big move for Xstrata, and likewise for Glencore. We've seen 5 to 6% increases in both prices, and investors are eagerly anticipating the perceived $700 million of annual synergies between the two companies should they get together. So a final look at the equity markets, and if we take a look at the FTSE 100, it's been about a 4% year-to-date increase in the FTSE 100, again nudging into new high territory there. The real action I think is further down the market capitalisation curve. FTSE 250 is up probably 10% year-to-date at the moment. So again, rotation out of defensives, taking on a little bit more risk, means that some of the mid and smaller size companies tend to be doing better at this stage.